Yesterday, the markets ended fairly mixed, although you could argue semiconductors continuing their very strong run. Likewise, Google up more than 2%, Eli Lilly, that's been on a very good run in just the recent period, and even Meta Platforms on a very slight rebound to the initial large drop they've seen. But overall, November hasn't really started solidly in the S&P. There is a lot of red. Maybe this is a bit of an insight to where this month is going to go, and a large reason for why we've seen a drop in the markets in just the last few days. AI bubble fears are now starting to get real. Investors need to consider, is this something that is just being talked about, or is there in fact some substance behind it? And we can see where investors are leaning towards, as sentiment is sitting in extreme fear. Just 1 month ago we were sitting in greed, but as always, these things can change very quickly. Now today we're going to focus on 3 stocks that reported after the market closed yesterday, and they have collapsed. We're talking 2 of them down more than 20%, 1 of them down more than 10%, and we want to understand why have they crashed and where we see them on the buy, hold or sell scale. And we'll kick things off with Duolingo, which is now trading below $200 in the pre-market. It is down 23%, and when the markets do open, very obvious to see, it'll be trading at a new 52-week low. It will in fact be a larger than 50% drop from their 52-week high of $545. And we notice both Seeking Alpha and Wall Street, even with their buy rating, we would consider this very weak. 3.5 is what is needed to flip this into a buy. And whilst it's down 14% over the last year, this doesn't take into account the drop we're seeing in the pre-market. This will be a more than 50% drop. Now we just want to highlight these numbers, and even though they're not updated given the large drop, ultimately is going to make it look a lot more attractive. Before this over 20% drop in the pre-market, it was trading at a price to earnings growth below 1. As always, below 2 is really what we want to look at before we consider companies. Below 1 does make it incredibly attractive, but that is on the basis you believe, in particular to Duolingo, it's not going to get disrupted by AI, and in fact, AI is going to be more of a benefactor. But you also need to consider some of the bearish stances. Whilst we won't cover it in today's episode, but you have companies like Google, like Apple, where they are trying to lean in towards the market that Duolingo currently have a strong foothold in. Now we will point out that they did have a double beat both on the earnings per share as well as the revenue, so you would be right in thinking, why is this company in fact trading at such a massive drop in the pre-market? But unfortunately, it's that word that we continue to say every single earnings season: guidance, guidance, guidance. If it's not at a bare minimum in line with what analysts want to see, then do expect companies to take a very large hit. And we can see here Q4 bookings is below what analysts wanted to note. They're expecting around 330 to 335 million. Analysts wanted to see above that at 344, and they don't really care that the quarter revenue in fact is in line with expectations. They want bookings to come in higher. And also, what's a bit of a kick in the teeth for the company is that they're expecting revenue growth 38% for this full year, which is above what analysts were anticipating of 36%. And we note here paid subscribers also coming in slightly higher than the estimates, but ultimately we can see here this bookings has really sent the share price down more than 20% now, as we've just highlighted. And as we said, this has not only overshadowed their revenue beat, but also the fact that for the full year they're expecting higher numbers than Wall Street anticipated. We also have a few interesting graphs to point out. The first one being, when we look at their paid subscribers, you'll notice here the blue line in fact highlighting the percentage growth every single quarter. Yes, they continue to grow the number of subscribers, but you will in fact see from around 2022 it has been decreasing. They're in fact saying here that the number of paid subscribers are starting to slow down in terms of the growth, but still credit to them, over the last 5 years paid subscribers has been growing at a compounded annual growth rate of 52%, that is every single year. And we also note that their daily active users are up around 49% going back to 2019. So there are a lot of positives with Duolingo. You can also argue that the valuation of this company is incredibly high, so they do deserve somewhat of a pullback. Question is, are we seeing a massive overreaction? And one analyst, after seeing this earnings report, has in fact lowered their price target to $330, that it's now sitting below $200. If you do believe that this analyst is right and we will get to our own DCF model valuation, you are talking about more than a 50% gain into next year. And just a few slides from their own investor presentation. First one, what is Duolingo? Well, in their own words, the mission is to develop the best education in the world and make it universally available. As we said, AI is definitely a disruptor for this company. That is at least what some analysts believe, what some institutions and clearly some retail investors see, because this share price is getting an absolute hammering, one that it has actually done for quite some time. But look, their numbers are still incredibly impressive when compared to the same quarter last year. Daily active users up 36%, monthly active users up 20%, paid subscribers up 34%. These are very, very strong metrics that you would expect from a growth company. Question is, did the valuation get a bit too stretched? Top line up 41%, bookings up 33%, and one thing that you don't typically hear about is a comparison of their margins. That has also improved. We love to see that. That is noted from high quality companies. Adjusted EBITDA 24.7%, now sitting at 29.5%. And again, you can see other metrics here really highlighting the strength in their growth. We also want to point out free cash flow, something we do use when we get to our valuation. That is up 51% from the same quarter last year, as well as growth in their free cash flow margin. And finally, looking at their guidance, importantly for the full year, they're anticipating their bookings growth to sit around the 32% mark, revenue to sit around the 38%, and their margins also an increase from the previous year. These are all very strong numbers. As we said, the issue here isn't whether or not the company is high quality. The question is, will AI really disrupt this company? And was the valuation too high that maybe now we could start to see possible opportunity? And look, no surprises, as a growth grade they get an A+, grew top line last year around 40%. We just heard this year they're expecting actually around 38%, which on both accounts, as you would expect, well above the sector in the low single digit. Historically though, they have been growing their revenue at a slightly faster rate, and earnings per share absolutely incredible, especially if you believe in the longevity of the company. They can hit it, projected 41% over the next 3 to 5 years, well above the sector comparison around 10 to 11. And importantly, their profit also very strong, sitting at an 8. Gross margin 72%, well above the sector at 39%, in line pretty much with their 5-year average. Bottom line also very healthy, 13%, above the sector at 4%, and also interesting to see over the last 5 years they were negative, they were losing money. It looks like they have turned a corner, very strong bottom line. And they also expect to close out Q4 very high growth, 172% to the year-on-year EPS. They've also outperformed in 3 of the last 4 quarters, so 75% track record may go some way to giving you faith they can hit the next quarter as well as the others, although Q3 we do notice for 26 a drop. That is quite far out, so we'll get a better idea in the next quarter earnings. And finally, before we get to our valuation, we want to look at the institutions. They hold 92% ownership of the company, where they sold $3.2 billion worth of shares in the last year. They bought a little bit more at 3.7. They also bought around twice as much in Q3, so net buyers in the more recent period. But actually, we can see previous quarter, they were slightly net sellers. So just interesting take that over the last year and in the most recent quarter, institutions did buy a little bit more than they did sell. And then we jump into our intrinsic value, which gets to $370 derived from the DCF based on this updated quarter. Now, when we take a look, first things first, we can see the growth rate we've used moving forwards at 15%. We have low, medium, and high, 10, 15, 20. As always, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Duolingo or any others. But one of the main takeaways here now for Duolingo, based on a reverse DCF sitting around $200, if you're buying today at that price, baked in is 4.1% growth moving forwards. If you believe that is very low, then straight away, potentially severe undervaluation. Vice versa, if you believe 4.1, not that maybe it's too high, but AI will disrupt it, the growth will dramatically drop, then potentially not a great opportunity or slight overvaluation. Now, using the growth rate of 15% and the discount rate, we get the present value of future free cash flow terminal price, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, getting to $370. That is 85% upside. Now, you may want to be more conservative and use 10%, using that $278, still 39% upside, or maybe you want to be, in fact, a bit more conservative than analysts who see it higher than 20%. That in its own right, $493 is massive upside, 147%, more than a double. Now, using the middle rate is something we typically do on the channel because we're not done. We want to understand what is the margin of safety. 10%, typical starting point, execute buy if it meets the 3 criteria, wide moat, strong financial metrics, good forward-looking data, which would indicate a buy at $333. But actually what we're seeing today is a 46% margin of safety if you believe that 15% growth over the longer term is reasonable. Wall Street themselves, on average, even with some of the changes, see around $410 into 2026. That is more than a double at 105%. So let us know your views on Duolingo. Is it a buy, hold, or maybe complete avoid? And we'll go one step further. We'll use the lower rate of 10% to highlight you're still getting an attractive MOS of 28%. So let us know your views today, Duolingo, where you see it. Now, before we continue, we want to let you know we have released our latest free weekly article covering 3 stocks we're buying this month. As always, we drop one every single Sunday morning completely free to your inbox, looking at severely undervalued stocks as well as what's gone in the market over the last few days. So click below, sign up, because you can also grab a copy of stocks that are severely undervalued for the month of November. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're looking at is Fortinet, which is down around 10% today in the pre-market. Now, this one will be trading right there towards the 52-week lows upon market open. And over the last 10 years, this is one that has massively outperformed the S&P, up nearly 1,200%. But we do notice just one buy rating from Seeking Alpha. Wall Street and Quant do give this a hold. And again, whilst it does get a D on the valuation grade and it's not updated yet until the market open, the price to earnings growth will be sitting around the 2 mark, which still is slightly higher than the sector median at 1.8, so you are paying a premium, but it will be a lot lower than their historical at around 2.9. So maybe one, as we said, when it does sit around the 2 mark, that is where we typically like to pay some attention to. And they also reported a double beat both on the earnings per share as well as the revenue. In fact, we noticed on a year-on-year comparative, both metrics are in fact up double digit. And we do have one analyst today that has mentioned this company as a hold after seeing their earnings report. They call this one somewhere around the $78 in terms of the fair price, which actually doesn't give it that much upside, especially in comparison to when we take a look at the likes of Duolingo. But their report was also impressive, as you would expect from Fortinet, double digit across the board. That includes their billings year on year as well as their total revenue, margins, and in fact free cash flow looking as strong as ever. And we can really highlight here the comparisons against 2024 Q3. This company continues to chug along in terms of their top line growth, and this does also apply to the majority of their other metrics. Although their gross margin is in fact down, we can see from 83.2 to 81.6, but operating side is up, although marginally 36.1, 36.9. As always, we love to see this growth in the free cash flow, and they're now expecting for billings for the full year to come in around 14%, top line revenue around 13%, and gross margin sitting around the 81% mark. Now, they do get a D plus on their growth grade, but last year they grew top line around 15%. As we said, for this full year, expecting around the 11 to 12 mark, which is slightly above the sector, but kind of a similar issue to what we saw from Duolingo. Their growth is slower than the last 5 years. Earnings per share, this is probably what makes it a little bit disappointing. Projected 14%, below the sector at 15, below the historical that was much higher at 17 in the last 5. But this is nonetheless a very profitable company, A+, 81% gross margin, well above the sector at 50. Also nice improvement to their 5-year average. The same on the bottom line, 31%. That is incredible to see. Sector much lower at 5. Even their own 5-year average is much lower at 22%. And they're also increasing the amount of cash they generate from operations, 2.4 billion, historically at 1.75. And if we look at the institutions with their 84% ownership, they sold 7 billion in the last year, bought nearly 50% more, but in Q3, should point out, they actually sold twice as much as they did buy. Otherwise, more often than not, we do notice, in fact, institutions are rather net buyers than net sellers. Now, our intrinsic value of $118 from the DCF is using a growth rate of 15%. It is actually higher than 2024, lower than 2023, but also much lower than their average at 26%. This company has had some very strong growth in the past in terms of free cash flow, and baked in today is 8.8%. This could be one for serious consideration if you do like this industry and maybe lack it and want it in the portfolio. So at 15%, we do notice 118, that is 51% upside. If you want to be more conservative, at 10%, $84, 8%. And if you want to go the other way at 20%, well, we see $164, more than a double at 110%. Now, using the middle rate of 15%, we do get a margin of safety of 34%. Wall Street, on average, see this at $90. We're talking 15% upside, not as strong as what we just saw from Duolingo. And if we want to go one step further and be a lot more conservative at the 10% mark, well, MOS does sit at 7. Again, if this is actually what you believe to be most reasonable at 10%, we can show you some targets. At a 20% MOS, a buy at 67, at 25, 63. And as we said, you can always grab a copy of this model by clicking below. So let us know your views on Fortinet. Is it a buy, hold, or complete avoid? And then we move on to Elf Beauty, another one that's getting absolutely battered down, 26% in the pre-market. This one was up over the last year. It will in fact now be down. Year to date, it will also be down double digit. Bear in mind though, over the last 5 years, this one has grown strongly, massive outperformance of the S&P at 506%, but has never regained its all-time highs. We're talking over $210, and will now be trading towards the lower end of the 52-week range upon market open. It's also got a weak buy rating from Seek Alpha, but Wall Street very near to the 4.5 that would flip this into a strong buy. And likewise from the previous two, the valuation grade doesn't look good. The price to earnings growth now will be below 2, sitting around 1.7, 1.8. Maybe one for consideration. All three of these companies in different industries, so it does give you a lot to think about. Is also trading below the sector median at this point, a 20% discount. It'll only get a lot more as the market opens. And we can see here they actually missed on their revenue but did have a fairly strong EPS beat. But EPS still nonetheless is down double digit year on year. Revenue, interestingly, with the miss is up 14%. And we can see the main thing here is their forecast comes below estimates. Remember, that is what we did say will impact companies during earnings season. And we can see here consumer worries, something we've talked about quite a lot, has shown up in fact in many companies' earnings, that the consumer is getting anxious. There is a lot of weakness in terms of their purchasing power. And we can see for this company, in fact, their forecasted EPS $2.80 to $2.85 is a significant drop from what analysts were expecting at $3.53, and revenue $1.55 to $1.57, again another decrease from analyst forecasts. So not great at all. Unfortunately, this is something we have seen quite a lot when we are looking at earnings. If you're not getting your guidance right, you will get severely punished. Also interesting to note, they say here that they weren't able to issue guidance in the prior 2 quarters. This was ultimately due to the uncertainty of tariffs. Now that they have, unfortunately, analysts did not like it at all, but we can see the chief executive is saying they're very proud of the guidance they're issuing, so a bit of a mismatch between analysts and ultimately management. But we can also note here the guidance they're giving for the sales is higher than their competitors and that their profit outlook is stronger given the tariff issues. Now their growth does come in at an A year on year, 19%, projected around 24, which we do note is well above the sector, but again very common in growth companies. They can't sustain very high numbers for very long, hence why it is lower than their 5-year average. EPS projected 16% above the sector at 6. As we said, their numbers are better than their competitors, but unfortunately still lower than their 5-year at 2021. And it probably won't surprise you to see that this is a profitable industry. B-, 71% margin above the sector at 36, improvement to their 5-year at 67. Bottom line 7.3 above the sector, but actually slightly below their historical 8.1. Cash from operations also a massive jump of 160 million from their 5-year at 60. However, we do note the sector does generate a lot more at 803. And finally, the institutions with their 92% ownership selling 1.7 billion bought a lot more at 2.8. However, like we just saw with Fortinet, they actually sold more in Q3. They also sold more in Q2. Having said that, some quarters though, we do notice institutions are buying a significant amount more than they are selling, but just in the last 2 quarters, they have continued to be net sellers. And our intrinsic price, $113, again from the DCF, is using a growth rate of 20%. Now reverse is actually fairly high in comparison to the previous, sitting at 16, but using this 20% moving forwards, you are looking at 28% upside. For the first time today, if we do use the low growth rate of 15, we're actually seeing downside of 7%. If you believe these numbers are way too conservative at 25, 153, 74. Now using the middle rate of 20%, you will be getting a margin of safety clearly, and that sits at 22%. Wall Street do like this. We saw a near strong buy rating, $135 into next year. That is upside of 53%. But let us know your views today. Is this one that should be a strong buy, hold, or complete avoid? We'll also factor in that if you do want to use the lower rate for consistency, as we highlighted for the previous 2, you're actually paying a premium of 7%. Is this one to consider? Wall Street definitely believe a buy the dip scenario, but do let us know your views on Elf Beauty as well as Fortinet and in fact Duolingo. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.